Hi, our group project report is about financial analysis of Royal Bank of Canada and Loblaw companies. We research, analyze, and present financial information about the RBC and Loblaw. Specifically, we focus on gathering data related to the company's bond issuances and stock price movements, and analyze their implications. The Royal Bank of Canada or RBC and Loblaw Companies Limited or Loblaw are two of the most prominent names on the Toronto Stock Exchange, each leading their respective sectors. As of 2023, RBC stands as Canada's largest bank with total assets of about 2.0 trillion Canadian dollars. That's approximately 1.5 trillion US dollars, supported by a global presence across personal and commercial banking, wealth management, insurance, and capital markets. Meanwhile, Loblaw is Canada's top food and pharmacy retailer, operating over 2,400 stores across multiple well-known banners, including Loblaw's, Shoppers Drug Mart, No Frills, President's Choice, and PC Financial. With roughly 220,000 employees as of 2023, despite being in different industries, both companies hold influential roles on the TSX and are key contributors to Canada's economic landscape. RBC is Canada's largest financial institution with over 2 trillion Canadian dollars in assets and a strong AA credit rating. It operates across personal and commercial banking, capital markets, and wealth management. Loblaw dominates Canada's grocery and pharmacy sector with over 2,400 stores and a growing digital health presence. It holds a triple B rating and is known for its defensive, stable performance in the consumer staples sector. RBC operates in a constantly changing world, complex rules, new tech, and demand for green finance. Its strong capital and stability help it handle economic ups and downs, but it still needs to move fast and meet ESG, or environmental, social, governance demands. Loblaw, as a Canada's top grocery retailer, it benefits from steady consumer demand. Still, it faces rising inflation, supply bottlenecks, and shifting shopper habits. By investing in digital tools and eco-friendly operations, it has growth potential if it can balance cutting costs with staying efficient. Common themes: both face rising demands from investors, regulators, and consumers for transparency and action on climate diversity and ethics. To stay competitive and create long-term value, they need strong innovation, risk planning, and ESG leadership.
To explain the pestle or political, economic, social, technological, environmental, and legal analysis of RBC versus Loblaw. In political, RBC operates in a highly regulated environment under both Canadian and international financial authorities. The stable political environment in Canada supports RBC's operations, but policy changes can increase compliance costs. Loblaw, on the other hand, is regulated in areas like food, safety, retail, and pharmacy. It must also navigate trade and labor laws, which impact its supply chain and cost, including financial services regulations in areas like its PC financial operations. In economic, RBC is sensitive to interest rates, inflation, and general economic growth. Global economic volatility can affect its operations and investors' confidence. Loblaw is in a defensive sector, meaning grocery demand remains stable, but inflation and consumer confidence still affect purchasing behavior. To manage cost, Loblaw uses bond issuances to access better borrowing rates. Social, RBC benefits from high levels of trust and loyalty, especially among older clients. Canada's aging population increases demand for wealth management services. There is also rising in consumer expectation for ethical and responsible banking. For Loblaw, consumers' trends are shifting towards health, with wellness and convenience. Groceries and pharmacy goods have inelastic demand, meaning they are essential, and the Loblaw's social responsibility effort further boosts brand loyalty. In technological, RBC heavily invests in digital banking, fintech, and cybersecurity. It leverages data and analytics and automation to improve efficiency and customer service. Loblaw is focusing on supply chain automation and e-commerce expansion. Its investment in online grocery services and data analytics helps improve inventory and reduce waste. For environmental, RBC promotes sustainability through green bonds and renewable energy financing. It faces growing pressure to manage climate risk and enhances ESG, their environmental, social, and governance performance. Loblaw is committed to waste reduction, sustainable sourcing, and energy efficiency in operations. The company continues to raise its ESG targets and improve environmental reporting. Last, in legal, RBC ensures strict compliance with laws like Basel III, anti-money laundering or AML, and privacy regulations. These require ongoing investment in legal and compliance infrastructure. Loblaw deals with complex food safety, labor, and consumer protection laws. It also manages an unionized workforce, which adds a layer of legal and operational complexity. This paper offers a complete financial comparison of Royal Bank of Canada (RBC) and Loblaw Companies Limited from 2021 to 2023, focusing on the three major areas: bond issuances, stock trends, and overall financial health. It begins by reviewing each company's bond activity, such as RBC's issuance of multiple covered bonds in various currencies with low coupon rates and maturities extending into the 2030s, supported by the AAA ratings from DBRS and a Lovelaw's sizable senior unsecured notes issued in 2022 and 2024 at roughly 5 to 6% coupons for long-term funding. Next, it tracks their stock performance, linking RBC's share price movements to interest rate trends and banking sector news, and highlighting Lovelaw's market volatility, especially during the May 2024 food price boycott through event-driven analysis. The paper then examines liquidity, leverage, and profitability. RBC maintains top-tier credit scores, strong capital ratios, and a return of equity around 14%, while Loblaw holds a solid BBB plus rating, moderate debt to EBITDA, and reliable margins supported by the growing revenues and earnings. By synthesizing these findings, the analysis delivers strategic takeaways for investors, showing RBC as the more stable, lower risk choice, and Lovelaw's as a strong consumers exposed retail performer with higher yield potential but the greater sensitivity to economic shifts. Let's review the bond activity between RBC and Loblaw from 2021 to 2023. In October 21, RBC issued 1.5 billion Canadian dollar of senior unsecured notes at 2.33% maturing in 2031. It aimed at funding general purposes and keeping liquidity flexible. In 2022, it issued 1.25 billion US dollar of Tier 2 subordinated notes at 3.5% callable after 5 years to meet Basel III capital needs. In 2023, RBC launched its first 1 billion euro green bond at 1.125% maturing in 2031. It supports the sustainability projects. Lovelaw's bond moves. In May 2021, it issued 350 million Canadian dollar at 2.284% due in 2030. In 2022, it issued 500 million Canadian dollar at 3.918% due in 2032. And in September 2023, it issued 400 million Canadian dollar at 4.48% maturing in 2035. Lovelow's bonds are simple, non-callable, and focus on locking in moderate rates for retail investments. Strategies compared for RBC and Lovelow's. RBC's bond issuances serve multiple goals: regulatory compliance, liquidity, and green financing. They include scalable features and currency diversification. Loblaws opts to clear long-term funding to support its retail operations, matching its cash flows needs. For the bottom line, RBC's bond strategy is multifaceted, covering regulation, flexibility, and sustainability, while Loblaw maintains a straightforward path, locking in stable financing for its retail growth. Over the 2021 to 2023 period, RBC issued over 3 billion Canadian dollar in bonds, including green and subordinated notes aligned with Basel III requirements. These included scalable features and were used to strengthen regulatory capital. Loblaw issued about 1.25 billion Canadian dollar in non-scalable senior notes, primarily for operational investments and refinancing. Notably, their coupon rates increased yearly due to rising interest rates from 2.28% in 2021 to 4.48% in 2023.
Royal Bank of Canada. RBC holds AA from Standard and Poor's and AA2 from Moody's, both with stable outlooks. These are among the highest credit ratings in global banking, indicating very low default risk. The ratings have remained unchanged for the past 3 years, even though inflationary pressure and interest rate hikes. This reflects confidence in RBC's strong capital base, liquidity position, and conservative risk management approach. Loblaw Companies Limited. Loblaw is rated BBB plus by S&P and Baa1 by Moody's, also with stable outlooks. These ratings are considered investment grade, though one tier below RBC, largely due to sector-specific risk like inflation, supply chain cost, and high retail competition. Despite these factors, Loblaw's ratings remain stable, backed by its strong and consistent cash flows and strategic debt management. Comparison and key insight. RBC's top-tier credit ratings highlights its systematic importance in Canada and its resilient, low-risk banking model. Loblaw's mid-tier, yet stable ratings reflect its solid financial management, especially impressive in a highly competitive and inflation-sensitive retail environment. In summary, both companies are well-positioned financially, with no expected rating change in the near future, as long as current economic conditions remain steady. Both the Royal Bank of Canada and Loblaw Companies Limited have used bonds to strengthen their finances. RBC issued bonds like green bonds to boost its regulatory capital and show it can handle financial shocks, keeping its debt stable. Loblaw used bonds to fund its operations and growth, which slightly increased its debt, but it's still manageable due to strong earnings. Ultimately, both companies used bonds carefully to improve their financial health in ways that fit their different businesses. RBC issued a 1.25 billion US dollar, a Tier 2 bond in 2022, and 1 billion euro green bond in 2023. Both counts as regulatory capital under Basel III. And as a result, its CET1 ratio is 13.2%, well above OSFI's 11.5% minimum, and thanks to the 3.5% domestic stability buffer requirement. Despite issuing debt, RBC's debt to equity stayed steady, backed by solid earnings and scalable bonds that offer flexibility if interest rates change. Loblaw, on the other hand, raised over 1.25 billion Canadian dollar through senior unsecured bonds between 2021 to 2023, pushing its debt to equity from 0.85 to 0.92. It maintained a strong interest coverage ratio above 6.5, meaning operating income easily covers interest payments. Uses fixed rate long term bonds, which shields it from interest rate swings and supports investment in stores, tech, and logistics. And the bottom line, RBC used its bond to strategize to strengthen the regulatory capital, maintain liquidity, and stay conservative. Loblaw, meanwhile, used debt prudently to fund growth and stay financially healthy, keeping leverage manageable and interest risk low. Here we observe stock trends over 3 years. RBC's stock showed cyclical movement, rising to $139.23 in early 2022, then dipping to $122.50 in late 2023. This reflects sensitivity to macroeconomic pressures like interest rate hikes and financial sector instability. Meanwhile, Loblaw's stock climbed steadily from $67.10 in 2021 to over $118.50 by 2023. And thanks to the consistent demand, digital expansion, and essential good positioning. This contrast highlights the volatility of financial stocks versus the stability of consumer staples.
For conclusion and recommendations, for Loblaw, accelerate e-commerce and supply chains automation, strengthen sustainability initiatives, boost customer loyalty via personalization, balance cost control with efficiency. And for the RBC, expand green finance and ESG products, invest in digital and cybersecurity, improve macro risk planning, enhance ESG transparency and regulatory engagement. In the case of RBC, the company should also focus more on its green finance project and proceed with investing in digital banking and cybersecurity. To address macroeconomic risks, the bank ought to improve scenario planning and to address stakeholder expectations. The bank ought to improve the transparency of its ESG reporting. Leadership in the market will be enhanced by proactive regulatory interaction and innovation in sustainability finance. In the case of Loblaw, the digitization of the business, especially e-commerce and automation of the supply chain, will be important enabling factors in the realization of growth opportunities and efficiency. The company is to improve its sustainability initiatives with emphasis on food waste, sustainable sourcing, and energy efficiency. The long-term resilience will also be spurred by strengthening customer loyalty by offering personalized service and engaging with the community. In general, the two organizations ought to focus on the concept of agility, stakeholder engagement, and ongoing ESG practice enhancement to operate in changing business environment and achieve sustainable growth. In conclusion, RBC and Loblaw exhibit different financial behaviors reflective of their sectors. RBC bands enhance capital adequacy and investor confidence but show exposure to macroeconomic volatility. Loblaw's steady growth and effective use of debt position it as a stable performer in the consumer staple sector. Moving forward, RBC should expand ESG-linked funds while Loblaw must manage debt amid expansions. For investors, these insights underscore the importance of sector diversification in balancing risk and return. Thank you so much. I hope we present and analyze the financial information about the RBC and Loblaw, specifically on gathering data related to the company's bond issuance and stock price movements and analyze their implications.